Hey everyone, this is our second video, and today we're going to talk about fair value gaps. Now, before we start, like I said, this is not an indicator. There are indicators out there, which is pretty convenient, but really, I don't suggest using indicators because when I was learning fair value gaps, there was this master, you could say, that was teaching me, and he said, don't use indicators. And I thought I was being smart, using an indicator. He's like, hey, look, I don't need to draw it out myself. And then he said, that's not how it works. You have to really rely on your eye instinct, the way you look at it, the way you find it. That's going to make the difference. Using indicators, well, the first problem is that you're not training your eye. You're not going to be understanding the market better unless you use your eye instead of an indicator. The second point is the indicators are going to make errors, and that's inevitable. The indicators might miss and they might do extra, which is not going to be good for you. Okay, so disclaimer. Okay, nothing I say here is financial advice, so do your due diligence when it comes to investing. So let's get right into this topic. We'll talk about imbalances. What is imbalances, also called as FVG, which is fair value gap? So I want you to look at this picture, right? This picture, what do you feel like? What is the first impression of this picture? You feel like a very odd. Do you feel a very odd feeling? Why is there a hole there? Why is it not filled? Why is it so imbalanced? Why is it so? It's lacking something, isn't it? So this is the feeling people get when it comes to fair value gaps. The market is just the same thing. When there are fair value gaps in the market is going to try to fill them. And what these gaps are is price gaps in the market. There are many types of gaps. There are volume gaps, there are fair value gaps, there are uh, liquidity gaps, liquidity voids, market session gaps. So there are many types of gaps, opening gaps and all that stuff. But in this video, we're going to focus on the strongest gap among all, and that is the fair value gap. Think of it as a magnet, a price magnet, and it would always gravitate towards these type of gaps to fill them, because these gaps, if you want the definition of it, they are inefficiencies. For example, let's get right into the charts. What do I mean by inefficiency? Let's go to a less crowded area. So when I say inefficiency, let's say that how do you spot a fair value gap first and foremost? So let's say you have a three candle move. Okay, you have a three candle move. Let's just say something like that. Okay, you have a three candle consecutive go. Okay, and there's the wick here, and there's the wick here, and there's the wick. Can you try to guess where the fair value gap is? Where do you think the gap will look at? Well, I hope you can pause the video for like 10 seconds to try and find it. So, you pause the video, the fair gap can be found in using a square. So, at the bottom of this candle and at the top of this candle, I use yellow color to represent fair value gaps. This little area that you can see here between this candle and this candle is what we call the fair value gap. Now, of course, there are going to be more candles here, and if there are no wicks, it still works as well. This is the fair value gap. Okay, the touch of this candle, which is the top of the first candle and the bottom of the third candle. Now, there are no specific rules that you have to count one, two, three, one, two, three, one, two, three. You can go with one, two, three, three, two, one, one, one. There's no consecutive candle counting, so you can just, as long as you can find a gap, you can draw it. There's no need to count which one comes first, which is the first candle, because if that's the case, you have to count the candles from the start of the chart, which is, of course, not realistic. So as long as you see a gap, you can draw it out. Okay, you don't have to count the candles. You don't care if it's three, four, five. As long as you see a gap, you can draw it. That's as simple as that. Do not overcomplicate the thing. I want you to look at this thing. You see four candles here, and you might say, "Whoa! I thought two fair value gaps require six candles because one fair value gap can be found in three candles." That's not how it works. You see, four candles, you have two fair value gaps already. So you don't have to count it. As long as you can see it, you can draw it. It's not like, oh, this candle is being used, so it's not relevant anymore. That's not how it works. So these areas are inefficiency of the market, where the market will try to gravitate towards these price points to try and fill these levels. So how you can take advantage and exploit this concept is that you want to take your trades around this area. You can use it for partial take profit zones. You can use it for manipulated zones which is areas that sometimes these fair value gaps are tricky because they're not always when you see them it's going to be exactly it's going to be a reaction. Sometimes though it's going to be a trap, and sometimes it's real and it's powerful. So here's an example. I'm just going to simply scroll on the chart. I'm not going to pick anything because you can find it everywhere in the chart. Let's say here, this is an example of a fair value gap. Can you see the candle here? Let me just zoom it in so you can see it very properly. So price point number one, the first candle. Let me see the candle. First, okay, second, and third. Between these three candles and the top of this wick and the bottom of top of this candle, the bottom of this candle and the top of this candle. Then you can link them together with a box. You can do it whatever however you want. You can use a box, you can use a line, anything like that. And you see the price touched into it. Okay, so let's say that you're gonna take a trade like this. Okay, if you don't want to complicate your trade, let's say you take it like this. You place it here and you take profit. It's a 1 to 1.9. Very simple. And of course, there are many other factors when it comes to taking history, but this is just a very simple example on how you can exploit it. Now, the market usually only reacts to these type of gaps for two times. Usually it's two times. We don't trust the fair value gap more than two times. So let's say there's a gap here, and if the market touches it one time, we're still going to trust it. If it comes back again, maybe. But if it's the third time, it's usually going to go and break past that fair value gap. So fair value gaps are not crazy walls that are not capable of being broken off, because they can be broken in. And so if you're going to draw your fair value gaps, you can leave them, usually preferably if you want the very high concentration fair value gap, you would probably just use it for once. If you want to use it for twice, you need other factors, but thrice not so much. I'm not fond of that type of stuff. Now, in this case, the market did react to it three times, but really, the third time was risky, really risky. I would not have risked it for the third time. So, other examples of fair value gap, they are usually, here's the tip: if it's the higher the time frame, the stronger the fair value gap. So, if you find your fair value gaps in very low time frame, they might be slightly unreliable. But if you find them at very high time frame, let's say the 4 hour to daily, they're going to be very powerful. The kind of catch here is that fair value gaps can be big. The higher the time frame you go, the bigger the fair value gaps the zone is. And when that's the case, it's hard for you to have a good entry, especially if you are a scalper, if you are a day trader. You want a very precise entry. But the problem with this is that fair value gaps can be big and you don't know exactly where to enter. You could enter at the bottom of it to play it safe, but you could have gotten a better entry, So the trick here is that in future lessons we're going to learn about a lot more different smart money concepts. Smart money concept isn't about fair value gap only. There are going to be a lot of other concepts. There are going to be a lot of other theories that you can imply on. And in the previous video, we learned about premium and discount. You can use that in your trading strategy as well. So another example where I can spot a fair value gap very quickly, and this is why I don't use indicators because it's going to be cloudy. So let's say I find it here. One, two, three candles. Between the top of this candle and the bottom of this candle, we have a fair value gap. The market touches right into it, touches it at the bottom of the wick, and then boom, it went up again. It touches it again, which is the second time, it goes up again. Now, of course, if you go into the micro perspective, you're going to keep finding these fair value gaps lower and lower and lower. You can keep finding it. So, a reason why I don't like using indicators is, let me show you an example. Let's say you want to go with fair value gap finder, and let's say you want to go with which one, the highest one, Lux Algo. So okay, so you can see, what is this? I have no idea what I'm looking at. you know this is crazy. See, this is not how you draw fair value gaps. This is very, really just confusing. Let's use another example. Let's see if we can find um, another easier one to look at. Just use it. I don't know where it went. Let's use another name. Maybe it would be better. Imbalance by ICT. Um, This is weird. All of these indicators are not working. Surprisingly, I don't know what's going on. I remember using one of them before, long time ago, and then I just quickly turned it off after my mentor told me like, don't do it. It's not going to be worth it in the long term. Yeah, this is how it looks like. It's telling you the fair value gaps that you can find. Now, I'm not saying that indicators are wrong. I'm saying that they're going to make mistakes every now and then. And sometimes it requires human intervention. So these are areas that they drew out for you. They drew out these areas for you. They drew out for you. But then they're not really that helpful. So I don't really like to use them. Use it to train your eyes because it will benefit you in the long term. So let's go to the daily or the weekly if you want to. This is what I mean by very big fair value gap areas in the high time frame. So where can we find fair value gaps? Here. Immediately, I want you to pause the video, spend about a minute time. I want you to find the fair value gap here. Can you find it immediately? Okay, if you're a very new trader, you might have a hard time finding it. But I'm gonna just specify it around this area, yeah? So if you have been exposed to this type of fair value gap, you might find it easier to find it. So main thing is don't try to use an indicator, okay? So here is the fair value gap. The top of this first wick and the bottom of this wick. So like I said, the fair value gap is huge. You don't really know where it would react at. You don't know where exactly it would react at. You can't guess it because this thing is very big. A general rule someone might do is draw a gun box in the fair value gap. So if there's a gun, if we learned about the gun box in the previous video, didn't we? So we're gonna use that concept and we're gonna draw a 0.5 equilibrium thing. Okay, so equilibrium can be used on almost anything, and including fair value gaps and balances. So we're going to draw a gun box in the whole fair value gap, okay? And we're going to consider trades at the zero point 0.5 error because this is what we talked about in the previous video. We're talking about premium. Okay, let's just flip this thing over. The green is supposed to be at the bottom and the red is supposed to be at the top. So the green is the discount. Discount is when the market will be pumping. So how can we apply what we learned in the previous video? Now, of course, if you have not watched the previous video, you can either finish this video and go to the next video, which is the previous video, or you can hop to that video first before you come to this one. Now, of course, if you heard of premium and discount already, it might be easier for you to understand. If you have not, you might want to watch that video. So let's just draw up this whole zero point 0.5 premium and discount. Premium, simple as that. When the market was in premium, nobody wanted to buy it. It just kept going down and down and down and down and down. Just kept going down. Okay. And there is the equilibrium. We breached the equilibrium line and immediately spiked up this candle. Now, there are no guarantees on whether we would stop here or not. We might go lower, we might go lower. And so you might say, well, that's a really unreliable strategy. What if it doesn't work? That's the thing. We're going to learn about more concepts, more theories in the future that you can apply them. You can stack one above another. So let's say we learned about fair value gaps. So we can apply fair value gaps, and then you can apply the premium and discount area. And then in the future video, we're going to learn about something called the order block. So you can apply the order block. And then in the future video, we have liquidity points. So we can apply another liquidity point. And then we have the breaker block. And then we have all these head and shoulder patterns and crazy stuff. You have the fail to return block. You have all these concepts in the future that you can stack up one above another, one above another, one above another. And it makes the trade more and more strong, the more confident you become because you know what's going on. Okay? So if you really want my opinion on this trade, I really think this thing is not going to do this. It's quite unlikely. Instead, I think I see something like that coming. And this is something that is very tricky, but mainly because of this wick. Now, we're going to talk about it in the future about what this wick really has anything to do with this entire move up. But that is one thing I want to talk about. There's another way you can find equilibrium is by using the gun box on this candle, the biggest candle you can find. You use the gun box on it, and you have an equilibrium here. And that equilibrium is going to be very similar if you use it at the swing low to swing high. So if you were to do it from the swing low to the swing high, the equilibrium will basically intersect each other, or they're going to be very close. So this is also another trick I learned. Okay, if you want to use the equilibrium of this giant candle, it's going to work. If you want to use it at the swing low to swing high, it's still going to work. Now, if you're really total beginner and you don't know what a swing high and swing low is, swing high is basically this, and swing low is basically this. Okay, so basically in a downtrend, it's the same thing. You know, a swing high, a lower low, a lower high, a lower low. Okay, and a uptrend is a higher high, a higher low, a higher high, a higher low, higher low, higher high, higher low, higher low, a higher high, higher low. Okay, so simple as that. This is what swing points are, and let's just use one more example on how powerful fair value gaps can be. Okay, so let's say we find another one in the weekly, and the weekly can be a bit um, big in the fair value gap term, so you might want to be using other concepts as well. And you can use, if you are a retail trader, which we all are, you can use certain indicators. I'm not a big fan of them, but in the future video I will talk about them in depth, and I'm going to teach you exactly how to use it instead of just blindly following these random lines crossing over. You know, people say crossover, but what does crossover over even mean? Why does the two lines intercept each other? What is the reason behind that move? In this channel, we're always talking about logic. We want to know, we want to understand, we want to implement. You know, we just don't want to follow the trades. You know, we don't want to just just kind of just follow like a sheep. People say this, so we just follow this, but we don't really understand why. Okay, so if you hop to the 4 hour, oh sorry, we were in the weekly just now. This is a weekly, so you can say up seven. This is a 7 day fair value gap. And right now you can actually draw another one at the daily time frame, and you can specify it. So that's a little trick that you can use. You can try to squeeze and specify that fair value gap. Okay. And now you have a more refined zone of the fair value gap. Instead of trying to enter around here, and you put your stop loss here and you target all the way at the top, that's not really wise, you know, because you have a it's just a bit hard. So a better option is to just refine it like this. And so instead of 1 to 3, you have a 1 to 5 risk reward trade now. Okay. So of course, fair value gap stop losses, it depends. You know, you need other concept. You can't just put a stop loss there. But for this educational purpose, we're just going to put it here. Okay. What we're gonna focus on the other hand, is how to refine your fair value gap. You can keep refining it until the 1 hour, but I don't recommend anything lower than that because it might become inconsistent. There are going to be too many fair value gaps. And one more mistake, okay, do not do this mistake, is draw every fair value gap you can find on your screen. You know, if you do that, you know, your screen is going to look very, very messy. You're going to have 10, 20, 30 boxes in your screen like that. So you only draw the relevant one. So if you're trading the daily, if you're trading the day, if let's say you're trading the 1 minute, okay, let's say you're trading the 1 minute, all the fair value gaps you need to draw is around here. You don't need to draw everything here, 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 here. Okay, you don't need that. Okay, if you're trading the 1 minute, okay, anything inside here is enough. Okay, you can go into the 1 minute here. In this thing, this is the daily, right? You go into the 1 minute, okay, and you draw the fair value gap. That's all you need to do. You don't need to worry about here, 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 here. There's going to be too many lines, and you're not going to be able to catch up with it. So, and trust me, it's relevant. Okay, so another fair value gap example is here. Can you see it? The price tapped into it, went up a bit, and then came down and touched. So this is something that I want you to pay attention on. Now, fair value gaps, like I said, aren't magical areas. There are times where it will be invalidated. There are times where it's not going to work, and that's just how it is. So let's just show you. Let me show you an example of how it did not work. Let's say here. Can you see this candle? Can you see 1, 2, 3? The fair value gap, the price blasted right through it. Okay, so fair value gaps are not the only concept you want to learn about. The reason why the market actually went up here is because of this liquidity point. This wick was a strong liquidity point. Liquidity is something that we will talk about in the future, but for this video purposes, we don't want to make it an hour or 2 hours long. So we talk about that in the future. But for now, this is a liquidity point, and the market hunted that liquidity, and it's not going to react to this little small fair value gap. Instead, it's going to blast right through it, even with this fair value gap. You might even see this one. Did you spot this fair value gap here? This is the one that I saw again. Two fair value gaps consecutively being broken away. Nothing like just butter going through, right through it. The candles blasting through the fair value gap like it's nothing. Okay, and that's just how it is. Okay, you have to accept that. Now, of course, if you go to the bigger picture, you're still going to find fair value gaps here. Okay, did the market react to it? Not at all. It just kept going up. Okay, so this is something that I want to talk about. Okay, when you see you're in an uptrend, you shouldn't be looking for fair value gaps to short. Instead, you should be looking for fair value gaps to long. For example, instead of trying to, oh, there's a fair value gap here, so I want to short, I want to place. Most retailers, when they first learn about fair value gaps, they will literally do this. They will put a trade here and they would put a stop loss right above it, and it's going to get blasted through within seconds, and they're going to be so pissed about it. Okay, and I'm sorry, that's not how it works. If it was so easy, everyone would be making millions from fair value gaps. Okay, it's a very simple concept, but it's a very really something that is very subjective. Okay, instead, when you're in an uptrend, which is swing high, swing lows, higher high, higher lows, you want to look for longs using fair value gaps instead of trying to short with fair value gaps. You see the difference here. Instead of trying to short with fair value gaps, you should look for longs with fair value gaps. So in this example, we want to take a long here. So let's say we went up, you have the fair value gap here. Okay, if you don't know, pause the video and find the wicks. Okay, and we tapped into it. Okay, and you can enter here, put a stop loss here, take profit here. Simple as that. Simple as that. 1 to 1.5, 1 to 2. That's how you gain the trade. Okay, and if you're in an uptrend, you're still going to be looking for longs instead of trying to look for shorts. Okay, this is also an example of another fair value gap. Can you see this candle? Can you see this one? And this white candle touches into this fair value gap. Can you see it? It taps, this white candle taps into the fair value gap. It goes up. So instead of trying to short with fair value gaps, which is a mistake, you should be looking for longs. I'm not saying that you can keep looking for longs only. Eventually there'll come to a point where the market reverses. But as for when we're in an uptrend, you should not be looking for longs. That is very risky in my opinion. Okay, so just quick recap. We learned about what fair value gaps are. Fair value gaps are inefficiencies in a market. If you draw out the economic chart, you would find an inefficiency zone, and that is where markets would try to fill this inefficiency to make it more efficient. Because of that, markets price are going to kind of deviate and gravitate towards fair value gap, deviate when it touches it and gravitate when it's not touched. In other words, we call it the imbalance. Okay, it's a very important concept. It's a very simple one yet important one. It's one of the fundamentals of smart money concepts. You can you can of course add it to your own strategy. If you're using an indicator, you can always add fair value gap to your strategy. It's not going to hurt, it's not going to disrupt your strategy. It's a very important one. Another mistake rookies do is they just keep drawing out all the fair value gaps in the charts, and they think I predicted everything that could go wrong. That's not how it works. That's going to complicate you, and you're not going to get a good outcome for it. If you don't trust me, do it yourself. Eventually, you'll learn the lesson. Okay. If you're trading 1 minute, just draw a little small zone, and you can draw out the fair value gaps that you need. Don't draw 100 different ones. If your screen looks too crowded and cloudy, you know you're doing it wrong already. Okay. So, fair value gaps. We learned. We learned about premium and discount in the previous video. So I want you to apply that to your trading instead. Don't just learn one thing and forget another. Don't learn about premium and discount and then forget about fair value gap. Use both at once. Combine them. Don't just use one and then forget another. They're meant to be used together. All of these are smart money concepts, just so you know. So don't just learn one thing and forget the other. So like I said, this is my second video, and I really hope you comment because your opinion really matters. I really want to know what you think about the video. Do you think I'm teaching too quickly? Do you think I'm talking too slow? Just let me know about the comments so I can kind of just improve on based on your comments. And if you have any questions about the video, feel free to ask me. If you have a confusion about what's going on in the market, why is this a fair value gap? Why isn't that a fair value gap? Why didn't I draw that one? Why did I draw this one? You can always ask me in the comment. I'll give you a detailed answer. And I hope you enjoy the day. Have a great day and goodbye.